Welcome back. Yesterday, I stood in front of you and asked a question that sounds simple and isn't. When China's CXMT listed at a valuation north of 400B and popped 471% in a single session, does that help U.S. memory stocks or hurt them? Resonance or a seesaw? Let's look at the bigger picture. Because Monday's tape just handed us the data. And I'll be straight with you. When I framed that question yesterday, I expected a cleaner answer. Markets hand you a clean narrative. This one handed me a mess, and that mess is worth more than any clean story. I break every cross-market event into 3 layers: macro, money flow, price action. Let's run it properly. The headline version of Monday is a trap. Layer 1. Macro. Nothing changed. I need to say that first. It's the thing everyone forgot by the closing bell. The DRAM supercycle is intact. HBM supply is still tight. The take-or-pay contracts Micron signed are still on the books. A Chinese IPO, even a 471% pop, did not alter the global supply-demand math for memory chips by 1 basis point. If you sold U.S. memory Monday because of CXMT, you sold a macro story that didn't move an inch. The supercycle cares about bit supply and bit demand, both unchanged. Layer 2. Money flow. This is the layer that actually explains what happened Monday, and almost nobody is talking about it correctly. The Dow was up. The Nasdaq barely dipped, down 18 basis points, basically noise. But memory and AI names sold off hard. Micron touched $879 intraday. SanDisk collapsed 11%. SOX dropped 2.3%. That's a rotation, not a panic. Money didn't leave the market. It moved within it. And here's the key point most people missed. The capital that bought CXMT in Shanghai was a different pool entirely from the institutions holding Micron and SanDisk. Different currency, mandate, time horizon, zero overlap. So this was never a seesaw between 2 connected pools. It was 2 unrelated stories on the same day. The U.S. memory decline was its own profit-taking event, dressed up in a China headline because headlines sell better than the sector was due to pull back. Layer 3. Price action. The levels I gave you to watch. Micron's 921 on the hourly, SanDisk's 1613, SOX's 12414. Did they hold? No. All 3 broke. Micron's hourly closed at $900, 21 below the 921 line. SanDisk, 1,278, down 11%. The 1613 level isn't even in the picture anymore. SOX closed at $11,555, below its short-term line at $12,058 and its mid-term line at $12,488. The 12,414 tell I gave you, history now. So here's my conclusion, and it's the faux one I'd stake my record on. What broke Monday were short-term and mid-term trend lines in an overstretched sector. What didn't break were the long-term structures underneath. Micron's daily long-term line sits around 712. SOX's around 10,832. Those didn't move. A short-term line breaking is data. A long-term line breaking is a thesis change. We had data Monday, not a thesis change. The fundamental case for the sector, supercycle, HBM vacuum, locked-in contracts, is exactly the same as it was on Friday. What changed was positioning and mood in a hot sector that finally found its excuse to exhale. Both reverse. Fundamentals don't. If I had to choose a stance right now, I'd choose elevated caution, not exit. Caution. Watch whether 921 becomes resistance on any bounce. Watch if SNDK finds buyers near its long-term support around 917. Chasing the panic or the China frenzy was wrong either way. Cash is a position. The institution that did nothing Monday isn't behind. It's uninvested by choice. And uninvested beats invested and wrong. Here's what most analysis skips. I can't tell you if next week memory rips higher or bleeds lower from here. What I can give is the condition. If 921 acts as resistance and price keeps making lower lows on the hourly, the short-term structure has shifted and we re-rate. If price reclaims 921 and holds, the breakdown was a shakeout that found weak hands. Same logic for SNDK at 1613 and SOX at 12,488. Until the tape shows which scenario is playing out, the only honest position is wait and watch. That's how you outlast the people trading the headline instead of the levels. That's my read on whether the CXMT ripple was real. 3 layers? 1 answer, short-term pain, long-term thesis intact. Structure over noise. But the structure got tested harder than in months. Respect the test. Don't predict the outcome, read it. A final point, because this is where retail gets hurt most. When a headline like China chip giant crushes US memory hits your feed, the instinct is to act. But the tape says Monday was just the exhale wearing a China mask. The investors who lose here aren't wrong about China being big. They're wrong about confusing a one-day rotation with a structural break. Structures don't break in one session unless they were already cracked. The CXMT pop exposed how stretched US memory had become. It didn't break the thesis. It clarified the entry. Watch the lines. They're quieter than the news, and they're right first.